Good afternoon, McGraw-Hill Education. My name is Matthew Doyle, and I'm broadcasting to you live today from 281 Summer Street in Boston, Massachusetts. This month, we're pleased to continue our financial education series. Last month was about women in banking. February was about taxation. This month, I have the pleasure to talk to you about the dream of homeownership. And today, we're going to be talking about navigating the home buying process, which can be a very complex or a very simple operation, depending on the folks that you have in your corner. So today, I'm very pleased to introduce to you our speaker is a certified financial planner hailing from the Washington, D.C. area. Rianka is going to talk to you about navigating the home buying process and making the process a pleasurable experience, but most importantly, one that helps you make the largest purchase we'll ever likely to make in our lifetimes. So with no further ado, Rianka, take us away.
Thank you so much, Matt. Thank you. Thank you, Matt. As Matt mentioned, my name is Rianka Dorsonville. I'm a certified financial planner, and today I will be talking you through navigating the home buying process. Okay? We have about 45 minutes together today, of which about 10 minutes is going to be for question and answer at the end. However, if you have any questions during the presentation, maybe clarification, a term that you don't know and need a little bit more information on, raise your hand, either in-house or virtually. We will be keeping track of the comment box, and we'll get them answered. Yes, the chat function. We'll get them answered. All right. So today's objective, we will be talking about setting the foundation to successfully purchase a home. Also answering the question, how much house can I afford? Also tips to finding the right realtor. And then also, what's the right mortgage for you? So first things first, we need to set a really good financial foundation if you are in the market to purchase a home. The key is to start 6 months in advance. And the reason why you want to start so far in advance is because you want to get a hold of your cash flow, understanding what comes in and what goes out on a monthly basis. So here is just a example of just a spreadsheet of I'm showing all of my monthly income that's coming in on a monthly basis, and then I'm writing down all of my expenses. So as you see here, it's showing the groceries, the car payments, student loan payments, but we're also keeping track of any savings that we have, such as like retirement. Because although we're starting to save for a home and we are keeping track of those cash flows, we do not want to neglect the savings that we are already doing. So I have the inflows, the expenses or the outflows, and then if I subtract the two at the end, or when we net the numbers, it will give us a range of how much mortgage we can afford. So in this spreadsheet, you don't want to include your mortgage because, your rent, because your mortgage is going to take over that payment. But you want to make sure you include everything else. So here is a way to try to figure out how much mortgage can I afford. And then also within the 6 months, you also want to check your credit report and also your credit score. Now you want to check it so far in advance because if there's anything incorrect on your credit report or your credit score is not in a favorable range, you have time to course correct. And having a really good credit score will give you the advantage to having a low interest rate in your mortgage. It's absolutely key. So let's say, for example, you're saying, well, Rianka, I just checked my credit score and I don't like it. It's not in a favorable range. What do I do? Well, you need to understand how your credit score is derived. And so that takes us to our next slide. It's a pie chart that just shows how your credit score is derived. The two that I want you to focus on is payment history and amount owed. Payment history, especially if you're 6 months out and you're not very happy with your credit score, you want to make sure over the next 6 months you're not missing any payments, you're making all of your payments on time. And then also the amount owed, or also known as your utilization rate, you want to keep that at 30% or below. What that means is if you have a credit card, let's say, for example, it has $1,000 credit balance. And if you want to keep it at 30% or below, the revolving balance that revolves month to month, you want to keep it at $300 or less. So on a month-to-month basis, if you have around $700, $800 a month that you're not paying off and it's revolving each month, your utilization rate is really high. So what's going to happen is that your credit score is going to be dinged for it. And for your utilization rate being at 30%, you want to make sure you get that down. So paying off debt may be in what you want to do over the next 6 months. And also, I want to point out credit history. Although it's 15% of what makes up your credit score, credit history is it's really important. Let's say, for example, you have a credit card that had that very high utilization rate, and you finally paid it off. You're like, yes. You're like, yes, I finally paid it off, and now I just want to close it. And I want to cut up this card. My answer to that is don't do it. So although you may have paid it off, and this is the card that you've had for the longest time, let's say for the past 10 years, you want to keep that card open. You can cut it up, but you want to keep it open because what that affects is your credit history. And so you want to keep that 10 years of history of having credit in your name. Now, if you close that account, and let's say your other credit cards that you've had for about 5 years, it shrinks your credit history, which isn't good. So if you are in the market to purchase a home with 6 months, starting 6 months out, you don't want to open any credit cards or credit lines or close any credit lines, okay? Just in case I need to bring this home a little bit more, I have an example of Melissa and Connie. So Melissa and Connie, they're in the market for a home. Their home is around $300,000, let's say. And Melissa has a credit score of 740, and Connie has a credit score of 640. Well, because of Melissa's really great credit score, her interest rate on this 30-year fixed mortgage is 3.5%. Connie's is 4.75%. From a monthly payment perspective, Connie is paying about $200 more a month. Over the course of the year, it's over $2,000, and over the life of the loan, it's almost $80,000 that she's paying more than Melissa just because of her credit score. So if you are in the market to purchase a home and your credit score, although you may qualify for the mortgage, but you don't have a really good or high credit score, you may want to hold off because the interest rates, you can get a more favorable interest rate and over the life of the loan, save. Another resource that I want to share with you all is Credit Karma. Credit Karma is a great way to check your credit report for free. You can check your credit report and your score. They use 2 credit bureaus, I believe it's TransUnion and Equifax. It's something I use personally and something that I have my clients use as well. We check it and make sure there's everything appropriate up there, nothing that is incorrect, because that can happen. If you have a similar name or a very common name, someone's medical bills can be in your name and in collections, and you don't even know about it. And so it's dragging down your credit score. So definitely want to check your credit report. Okay. There's a few ratios that I want you to be aware of. Some crucial, critical ratios. The first one is the debt-to-income ratio. And lenders like to see your debt-to-income ratio at 36% or below. This is your monthly debt payments, such as your student loans, your car payments, anything that's revolving on a monthly basis, your credit cards. They want to see your monthly debt payments here showing $1,800 divided by your gross monthly income, and that ratio should be at least 36% or less. So as you're going through the exercise of figuring out what's your income, your inflows and outflows, and working on the your spending plan, this is a ratio that you definitely want to look at. Another important ratio is the housing ratio. The housing ratio, you probably won't be able to really get accurate numbers until you start working with a real estate agent, because the housing ratio takes into account your mortgage payment over your gross monthly income. And your mortgage payment includes your principal, your interest, the property taxes, homeowner's insurance, mortgage insurance, as well as the association fees. And for this, lenders like to see your housing ratio below 33, 36%. But depending on the mortgage or the program that you're going through to get your home, I've seen some lenders saying as low as 28% or below for the housing ratio. So it really just depends. Any DIYers in the house, do-it-yourselfers? Yes, yes, okay. I see some hands. I see some virtual hands as well. So if you are a do-it-yourselfer, you will love this website called dinkytown.net. Dinkytown.net is full of financial calculators. It has an entire section for mortgage calculators. And this is just an example of one of the many calculators that they have on their site. But definitely, if you want to get ahead of the game and just truly understanding where you are financially and getting control of your financial foundation, this is a good resource to have. Okay. Some other percentages or numbers I want to throw out at you is for your down payment and your closing costs. So with the down payment, your down payment is probably going to be the largest expense that you have while going through the process of buying a home. The down payment can be anywhere between 3% to 20%. As little as 3%, as much as 20%. I mean, if you can pay for your house in cash, that's awesome, but most people try to put at least 20% down. And if you put 20% down on your home, then you do not have to pay a premium or mortgage insurance premium, which we'll get to in a later slide. Then closing costs, they can range anywhere from 3 to 5% of the total loan. So you may be saying, well, Rianka, you just said I had to pay 20% for the purchase of my home. What's this closing cost? Well, the 20% goes towards the purchase of the home. So it goes actually towards the loan itself. The closing costs, it goes towards the closing costs. There's so many fees that are associated with closing on a home. That is something that you have to pay for. But if you have a good realtor on your team, which is something that we'll talk about as well, they can negotiate for you and say, well, if this person really wants to sell this home, let's try to see if we can get them to pay the closing costs for you. And so that's why it's really great to have a very knowledgeable realtor on your team. Also, you definitely want to establish an emergency fund. So if we go back to the spreadsheet where you are keeping track of all of your income and outflows, one line that you want to make sure that does not go away is your savings. Because when you buy a home, inevitably something is going to happen. And you want to make sure that you have the funds to pay for anything that breaks down, especially if you don't have new construction. So here it says prepare for a few months of the mortgage payment and savings reserves, which is definitely true. But for an emergency fund, you want at least 3 to 6 months of fixed living expenses in your account. Okay? So as you can tell, buying a home, it is a process. It is not a one-time event. We've already started 6 months in advance. You're checking your credit report and your score. You're doing the exercise of your monthly cash flow. And now you have to find a great realtor, as I just mentioned. And you want to find a realtor that you trust, because when you're choosing a realtor, you're choosing a team. And you want a very knowledgeable realtor, because this realtor will have the loan officer that is very knowledgeable that they can lean on. They will also have really great agents or insurance agents for when it's time to do, purchase the homeowner's insurance or any other insurance that you may need in the process of buying a home. So understand that you are choosing a team. Also, you want to get pre-approved by a mortgage expert, and the realtor can be someone that can help you find a loan officer to help you get pre-approved. And during this process, they're going to verify that your credit score and your credit report is in an okay range. If it's not, and we're 6 months ahead of time, then we have time to course correct, which is key. As you saw with Melissa and Connie, you don't want to be that person paying $200 more a month. So now it's like, okay, well, how do I find a good realtor? The top 3 resources, the number 1 will always remain the same. Ask a family friend or a relative, and ask them to refer their real estate agent, or maybe not, if they had a good experience or if they didn't. But hopefully they had a great experience. And if so, that's probably the first person that you want to speak to interview. The second choice is to visit the neighborhood where you would like to purchase. And so maybe there are some homes for sale, and there are some real estate agents' names on these different for sale signs. Give them a call, or research them to see if this is a realtor for you. See what type of team they have. And the third choice is Zillow. Are you all familiar with Yelp? Everyone's familiar with Yelp. So Yelp is a platform where you can rate and write comments about restaurants. So Zillow has a very similar platform where you can rate a realtor. So here's Ruth. Hi, Ruth. I don't know who Ruth is, but she has really great reviews. So this is from Zillow. I'm not affiliated with Zillow, but they have a really great platform, especially for home buyers. So I wanted to share this resource with you. So here, as you can see, you can research Ruth and see that out of 5 stars, she has 4.9. And in the last 12 months, she's sold 14 homes and 37 reviews. And as I perused the reviews, they were really awesome reviews. So if I was in this area, and she's in Boston, if I was in this area and in the market for a home, I would call Ruth. So you can do that as well in your area for everyone that's joining us online. Zillow is nationwide, and you can start searching for realtors in your area. All right, you have your finances in order. You're in a great range for your credit score. You found a realtor for your team. The next thing is finding a home. And what is the best type of home for you? You have to decide, do I want to go single family? Do I want to live in a condo? Do I want to live in a townhome? It's up to you. Do I want to purchase new construction or not? There's pros and cons to new construction. Some of the pros are you're the first family to live in the home, so you're the first generation home buyer. Also, you can fix up this home to your standards and to your liking. You can pick anything and everything down to the doorknob of, how I want this house. You can pick the countertops, Corian or granite, and, so many fun things. The con to new construction is that you get to pick so many things, and with these upgrades comes cost. And typically what most folks do is roll the upgrade cost into their mortgage. So when you're walking into this home, you're already upside down. because your mortgage is more than the value of your home, because some folks can walk into the showroom and, you know, pick out everything, change the doors, change the carpet, and walk in with about $30,000 to $50,000 worth of upgrades that you're paying for over the next 30 years. So beware of that. Next, we have location and neighborhood. What type of street is the house located on, especially if you have young children? Is the street right behind you, is it a busy street? And if so, do you have a fence in your yard? You want to pay attention to the home surroundings. Also check out the local amenities or what's happening in the neighborhood, what's some of the future projects that are going to be happening. Grocery stores. I know when my husband and I were figuring out where we wanted to buy, we wanted to make sure we had a really great grocery store local. We're foodies, so we need a good grocery store. Also, school district. As I mentioned, if you have young children, you want to make sure you have a good school located near you. Here's a website for your reference that you can check out. All right, you found your realtor, you found the house, and now we need to figure out what type of mortgage are you going to have? What type of loan? And so here we're showing the VA or Veterans Affairs, FHA, Federal Housing Administration, conventional. And with those three types of loans, you have various, if it's a fixed rate mortgage, if it's a variable, also known as an ARM, adjustable rate mortgage, which we'll get into. But let's talk about the first three types of loans. With the VA loan, what I want you to know is highlighted in red. And one, it's available to active and veterans of the U.S. Armed Forces. And also, it's the only loan option that offers 100% financing. The biggest debate or trying to figure out what type of loan you want truly comes into FHA or conventional. Which one is the best for you? And so here I have a chart. There's a ton of differences between a conventional and FHA loan, even more than what's on this chart, but I'm just highlighting the red points that I want to bring home to you. The first one is with FHA loans, you can have a lower credit score, as low as 620. With conventional loans, higher credit score. FHA loans, interest rates are typically lower, and that's because FHA loans is backed by the government. A lot of things are subsidized by the government through the FHA loans versus conventional, the interest rates are higher. FHA must be owner-occupied, and conventional does not have to be owner-occupied. What does that mean? Well, you've been living in your house for about 5 years now. You love this home because it was your first home, but you have opportunities elsewhere. And now you want to move, purchase another home, but you want to keep this home in the family, and so you want to rent it out. If you have an FHA loan, that can't happen unless you refinance it out and get a conventional. But if you have a conventional loan, you can rent it out or stay in it, whatever you want to do. So although you're walking into purchasing a home today or 6 months from now, you want to think about the future as well. The resale value, the type of loan that you have, etc. So within the VA, FHA, or conventional loans, there are different types of terms or the lengths of the mortgage as well as interest rates. So the first one I want to talk about is the fixed rate mortgage, which is the most known and the most typical is the 30-year fixed rate mortgage, which is the example we used for Connie and Melissa earlier, where your interest rate remained the same for the life of the loan. It's not going to go up or down. And so here is a chart that shows an example of a 30-year loan, fixed payments, where the payments remain fixed over the years. However, over the years, you start to pay more principal than you do interest. As soon as you enter into paying mortgage payments, you're pretty much paying all principal. You're pretty much paying all interest, which is shown in the purple. And then over the years, as the mortgage amortizes, you're starting to pay more principal. You also have the option of paying biweekly payments, where you'll pay your mortgage every 2 weeks versus on a monthly basis. And then as a result, you'll pay an extra full month's payment each year, and the loan is paid off typically 6 to 8 years earlier. So if you have a very flexible cash flow, a lot of cash flow coming in, then that may be an option for you. However, lenders typically charge a higher interest rate for that in order to set up biweekly payments, because a lot of people don't opt for that. And so you're being fiscally responsible, and they're going to charge you for it, unfortunately. The other characteristic of a mortgage that I want you to be aware of is an ARM, or the adjustable rate mortgage. And what I want you to understand with this type of mortgage is that your interest rate is fixed for a short period of time. And after that, you are at mercy of the market, where depending on, so let's say, for example, you have a 5-year ARM where your interest rate, typically lower than a fixed rate mortgage, your interest rate is low. It will remain the same for 5 years. After 5 years, your interest will adjust on an annual basis, and it can go up and down, up and down. The reason why most people don't steer that way, one, because you want to know how much mortgage you're paying each month. Some people opt to go into an ARM if they know for certain that they are not going to be in this area for a long time. I had a couple who opted to do a 5-year ARM. They're in their 3rd year, and they're moving out of the area. But because of their income, it made sense to opt for a 5-year ARM or purchase a home versus just rent. And they were in a area that was developing, and so they got really lucky with this, but I typically wouldn't recommend that for my clients. Question from the audience?
If I have an adjustable rate mortgage and I end up staying, how do I get out of it?
The question is, if I have an adjustable rate mortgage and I end up staying, how do I get out of it? The answer is typically you have to refinance. And so you can go into an adjustable rate mortgage or ARM at 2.7%. And now it's time to refinance. And it just depends on where your credit score is today, your debt to income ratio, all of the critical ratios that we just mentioned. And it depends on all those factors, and then you'll get a new interest rate. Okay. So some additional terms I want to make sure that you're aware of, and not just make the assumptions. You know what PITI is. So PITI, principal, interest, taxes, and insurance. So if you can recall the chart that I showed, over 30 years, the payment stayed the same, right? Well, that's principal and interest. The two factors that may change on an annual basis is taxes and your insurance. It just really depends on the county you live in, the state you live in, etc. And also the private mortgage insurance. So I mentioned earlier, in the earlier slide, that if you don't put down at least 20%, then you're stuck paying the private mortgage insurance. And this is a premium that you pay on a monthly basis just in case you default on your loan. So the lender is saying, well, you didn't have enough money to make a down payment on the home of at least 20%, so we're going to let you borrow this money, but we're still taking a risk on it. And because of that, we're going to make you pay private mortgage insurance, where this is an insurance that goes straight to the lender. It doesn't go towards your mortgage at all. So it's a sunk cost every month. some more resources that I want to share with you. There are state-specific first-time homebuyer programs. And so if you go to this link, you'll find this interactive map. So I know we have folks here in-house, but we also know that we have folks joining us across the nation. So I want to make sure that you were not left out. So if you go to this website, and you can click on any state that you live in and find first-time homebuyer programs. This is an excellent, excellent resource that you want to take advantage of. I'll make sure you get the link. And if you didn't catch the link, don't worry. Matt just informed us that he will make sure that this information is sent out for you. So why home ownership? I just told you that you have to start prepping 6 months in advance. And now you have to do these crucial, critical ratios and making sure you fall in line and do some cash flow and spending plans and find a team with a realtor and all of this. Why home ownership? Well, one, it's a sense of stability and permanence. You don't have to worry about every year, is my rent going up? Is it affordable? If it's not, do we have to find a new place? And then also there's some financial benefits, like the mortgage interest tax deduction and the deductibility of property taxes. So although there's a lot of preparation, understand that it's a process, not an event. At the end, when you get the keys to the home and you finally walk in, you're going to be so happy you went through that process. All right, any questions? Okay, we have some questions. One moment. Okay, so the question is, what is interest rate like on second homes, vacation homes, and investment homes? The answer is it's much higher than your primary residence. I'm not sure how much higher. It really depends, but the lenders are seeing as though they're taking on a risk, understanding that you're buying a second property. And so typically the interest rate is going to be higher.
Next question. I have PMI in my house. How do I get rid of PMI?
Okay, so the question is, I have PMI on my mortgage payments. How do I get rid of it once I get to 20%? So once you get to, I believe the magic number is 78%, you want to call up to your financial institution, say, hey, I've been making payments on time. I'm at 78% or 22% equity in my home. Please take away PMI. And typically they should, unless you have an FHA mortgage, a Federal Housing Administration mortgage. And then typically the PMI is going to stay on your mortgage for the life of the loan. So you want to be aware what type of mortgage you're getting into. How do you get rid of it? You have to refinance. So once you get to 22% or 20% equity in your home, typically they will, the financial institutions will take it away. However, if you have an FHA, then you will have to refinance. Really great question. Do I have to be present for the closing of my home? And no, you do not. You can get a POA or a power of attorney to sign on your behalf. If this happens, you want this person to be, you want to really trust this person and trust this person a lot. What are the pros and cons of taking an existing home totally paid for as collateral for buying? The question is, what are the pros and cons of using a paid for a home for collateral for a new home? What's the pros and cons? Well, I would probably say something that you'll have to be aware of is that if you're using the equity from your primary home to purchase a second home, you're going to get it at a premium. If you have to do kind of like a cash out refinance or take a second loan on the home to use that equity for the second home, you're probably going to pay a premium for that. And then also with the second home, if you don't have 20% down, you're going to pay a premium with the interest rate as well, because this is the second home, or it's looked at as an investment property or a vacation home. Any more specific, I would probably say you would want to talk to a loan officer, and they can give you specifics on your specific situation. Or you have some resources here where you can have one-on-one conversations with a program that your company offers called Ask a CFP, where you have 30-minute sessions with a certified financial planner. Any other questions? Okay, that's all the questions that we have in the chat box. If you have any other questions, still feel free to send them, and we will make sure that they get answered. But we do not want to leave without letting you know the resources that is offered to you by your company. One is the Financial Wellness Checkup, where you'll gain awareness of the critical numbers like your credit score, building the foundation for financial wellness. It's a link right here that will give you more information about that. Also, the Ask a CFP, and also there's free tools that are provided to you. Credit protection powered by LifeLock, and then also a document management tool powered by the virtual Strongbox. So definitely take a look at this website and take advantage of the resources that's offered by your company. All right. Well, we definitely want to thank you for joining us today with the presentation of Navigating the Home Buying Process. Again, my name is Rianka Dorsonville, and thank you.